So let's, first take a look at the charts, just see where we're at and everything, and then I'll talk to you a little bit about what I think is kind of extremely important in intraday trading, and then we can talk a little bit about some of the stuff that we're doing in BK. And if you guys are interested, you can always come join us. So first of all, anybody have any particular? Just type in any chart positions or anything else you guys are thinking about. Feel free to post them, and I'll take a look at them. But for now, I just want to take a look at the majors. And I think the key takeaway right now is it's a very, very quiet week this week. We don't have too much on the plate, as most people on both sides of the Atlantic are actually at the beach right now. So it's unlikely, unless we get some massive geopolitical tensions, something really serious happening. I think it's going to be unlikely that we get any significant kind of move. The one thing I think is interesting is that there's no doubt, if you're a longer-term trader, that the euro is in a very defined, very clear downtrend, and that every rally is a sell at this point. And I think everybody, if you're trading trend lines, you could say 34.50 would be a break of the trend. I really don't think the break of the trend really comes in until you get a horizontal break over here. In other words, if we come back, close above 35, then we go from a bearish position to a neutral position. But until and unless we break 35, I think every rally is a trend, is a sell here. But having said this, the 33.50 is clearly a very, very strong support. And you'd have to go back out here. If we go back out like a year, you see that this 33.50 is pretty significant support over here. Around 3,300 is the next level, like right over here. From November, and then below that is the 3,100. So ultimately, I think the euro makes it to 3,100, but it could be a little bit of a jagged ride, and certainly it's due for a little bit of a bounce. So the main thing for the shorts to be concerned about is that momentum has really died out. What you see here is that the last 3 days we have not been able to break the lows. So this 33.30 is pretty much been the bottom, and until and unless we break the 33.30s, and reinitiate further extension of the downtrend, we could be like in a consolidative mode. But I think the trade here is much less about trying to pick a bottom and much more just trying to sell every rally into this move, because longer term the conditions in the euro remain to be very, very negative. I think the eurozone is in danger of basically being in zero growth, and if we're in that position, it's going to be very, very painful for euro longs for a long time, because the relative outperformance of the U.S. is eventually going to start to really take shape. And I think what you saw here when you broke the 35s, 35 was a big support level. We tested it once, we tested it twice, we broke it a third time. That was a big, significant sentiment change with the market basically saying, the euro is no longer worth it. We're now going to be in a permanent or quasi-permanent recession state in the eurozone. So the prospect of getting long euros is no longer nearly as attractive. And that's pretty much, I think, what the charts are showing you here at this point. So we may have a few, half-hearted rallies to the 34.50, 3,500. I think at 3,500, there'll be a lot of sellers. If we take out 35.50 and close above 35.50, I think I'm clearly wrong at that point. But unless we do that, that's pretty much where we stand on the euro. And that's how it's looking. The yen is really very quiet. The yen has just been in this massive, the yen is just basically building a base for the potential. And this is actually, I think, the key takeaway from everything, but a potential of U.S. returning back to normal monetary policy. If we do get that next year, if the Fed actually begins a tightening cycle, this whole big base leads to a big explosion, and we're looking to 110, maybe even 115 yen eventually. But until you get a fundamental move, we're basically just treading water, and that's really what the chart has been doing the whole year round. We could have a completely opposite move too, which would be very surprising, which would be move towards risk aversion, lower U.S. yield. Let's say U.S. rates going down to close to 2%, complete and total sort of a freeze in global economic activity. That the moment we break this 175, that's been a really big support level. if we break this 175, we go towards the parity level. That's a very, very negative sentiment move. And at that point, it becomes, I think, a completely different story. Boyke likes the fact that I'm on the day chart. Boyke, what are you trading right now? What positions are you looking at? So yen is no man's land, and it's not going to be a trade until we start to really significantly. The first level for yen to really break out convincingly is above this 104, where we've failed several times. Then we got to take out the 105s. But I think if we're at 104, that would be a pretty significant level because we've had such a strong base here in the 100, 101s, 103s for such a long time that a breakup would really signify a potential breakout move. Somebody wants to talk about the loonie. Let me just go through all the majors, then I'll take a look at the loonie. So cable has been in essentially a slow motion car wreck, right? I mean, what's interesting about cable that it's just been a very stealth, huge correction, right? It went from 72 effectively down to 67, 85 with just barely, look at this, like 20 straight days of negative moves, only a couple of days of up moves, just been a very, very strong move. Having said this, though, we're now obviously coming into this double bottom support level of 67, which I think is pretty significant. So in order for us to break that, we really, really need a significant break to the downside. And that would, I don't really know what, you would have to have slowdown in the UK economy and a complete unwind of interest rate expectations. I don't see that happening. I basically see cable becoming a bargain here at 67, 66 for the time being. In other words, if you're bottom fishing, probably these levels are going to be good support levels. So you kind of, you scale down you start buying around 67, 66, and you stop yourself out completely below 65. If we get down to these levels, there's clearly, a significant move to the downside in cable that you missed. But I think this whole area here represents probably an interesting buy point, but a buy point for like a couple of 100-point rally, not necessarily a big continuous rally. The reason why there's no continuous rally is because I think the Bank of England stays on the sidelines for much longer than everybody thinks. We have a couple of things that are coming up that are not economic that will keep the Bank of England stationary. One, you have the Scottish election coming up in September. That's probably going to pass without too much hullabaloo. But then you have the UK elections coming up in May, and it's very unlikely that the Bank of England is going to do anything on the interest rate front ahead of the elections, which means that they're going to pretty much match the Fed. If basically you assume that summer of next year, 2015, is when assuming everybody has a relatively steady growth profile, is when all the central banks begin to resume their normalizing policy. Then the Bank of England just simply matches the dollar. So you could have a long period of time of just churning and burning with cable not doing much. But at these levels, the 65 to 67 level is clearly going to be a support level. So I think they'll probably find some bidders around here. So I would be a scaled down buyer here with a stop at 65. Aussie is kind of like dead money right now. Obviously, I don't think it's actually, if you look at Aussie, it's forming a pretty serious distribution top at this 95. It's kind of ran out of gas with 95. At the same time, I don't think it's too much to the downside. 92 is very much the near-term support, and then below that, it's going to be the 90 support. So can the Aussie unwind all the way down to 90? Very much so, because I think the RBA wants to talk it down, and I think you're going to see a slowdown in China. And even if you don't see too much of a slowdown in China, what you see that's really interesting is a slowdown in Chinese demand for Australian goods. So even if China performs well, but then that doesn't necessarily, but basically does it by transforming itself to a more retail-based economy than a construction economy, that's not positive for Australia, and that could create further downside action for the Aussie. Black Hat is asking me, do we have a fundamental change on cable? We have not had a fundamental change on cable in a sense that the economy in UK still continues to grow well and perform well, but it's growing. The rate of growth is slowing, right? So I think the best growth days of the UK economy may be behind it. UK economy looks like it still is going to be continues to be positive, but not necessarily as positive as was front of the year. If you have any kind of turbulence in the capital markets, if equity markets begin to start to slide, you have enormous amount of pressure in cable, because effectively UK, UK is a stock market economy, a hedge fund economy, and if you don't get a lot of support from that area, you won't get the growth that I think the market is looking for. So it could be a disappointment. John is asking, what's the title all about? No Good Traders. It's about, what I want to talk about, which I'm going to talk about in just a few minutes. I just want to talk about charts for the first 10, 15 minutes. And then I'll talk about the essence of what I wanted to say to you guys. But anyways, Aussie, it looks like a big distribution top. And actually, one of the more interesting trades that I kind of like on a longer term basis is short Aussie Kiwi. You got a triple top over here. I think basically as long as you stay below 111, so you're only 150 points away here in terms of risk, I think we have a distribution here. And you get, again, underperformance of the Australian dollar now that's going to be reflected in the Aussie Kiwi cross. It's a slower move, but it's a significant move. And you see on the charts here, this is a very, very serious, resist level. And you have at least to 108, possibly, 106 on the move here. I was just in Singapore last week, and that was one of my more interesting Asian trade ideas of, relative underperformance of Australia against New Zealand. Because the reason why is if China basically is ending construction and starting consumption, that's positive New Zealand, which supplies foodstuffs, right, which is consumables, and negative Australia, which supplies construction materials. So that's why the trade is I think an interesting trade at this point. So now we can get to the to the loonie. Somebody was asking about dollar CAD, which had horrendous employment data, by the way, right, on Friday. So big pop in a typical loonie fashion. A little bit of a return here. This 110 seems to be a little bit of resist. I actually think, I know everybody thinks that this 110 is kind of a big resist level, but I think the loonie is weaker than it appears. And this whole rally down to 106 as a result of slightly better Canadian data that's starting to really fade right now. I still think there's more structural problems in the Canadian economy than there is in the U.S. economy in some ways. And once we take out, like if we close back above 110, I actually want to be there. I think that trade is good. That could take us right back to like 112 and test the highs. So the loonie to me would probably be a buy, or dollar CAD to me would be a buy above 110. If we don't get there, then yeah, I'm wrong, and we probably have a little bit of a correction with the 108 support as the next level. But I kind of like the breakout here because I think the dollar versus CAD story is going to get stronger, not weaker. Any other crosses? Any other pairs you guys want to take a look at? Kiwi Swiss. Kiwi Swissy, okay. It's obviously not a high moving. You wanted to look at Kiwi and the Swissy. Okay. All right, let's take a look at Kiwi and Swiss. Boyke wants to just look at the Kiwi. I like Kiwi at a support level here. I like it at 84. 84 is a double bottom here. We're kind of double bottoming. You don't have too much risk here. Maybe I'm 100% wrong, and we'll get stopped out below 84. But I kind of like the bargain area here. You're at a double bottom area. A lot of the negative stuff out of New Zealand has come out. Yes, they're not going to raise rates anymore. Yes, it's no longer the carry darling, but it's still 3.5%. It's still the best thing in the OECD world. And I think just, for near term, it's a better trade than it's a better buy than a sell at this point because of the potential bargain at this point for 100 points. I'm not looking for a massive rally, but I think this is a pretty decent bargain area. You've also had 3 days of non-declines, right? Which is also very positive. And Swissy, right? So Swissy is kind of interesting too. So Swissy is a look, in my opinion. I haven't looked at Swissy in a long time, and I finally started to get interested in Swissy because we're coming up to these very important levels here. So we need to see, Swissy got a lot of support from risk aversion, but if risk aversion kind of dies out, and this is really going to be a U.S. yields trade. If we get above 2.5%, I'm not being flippant here, but I wonder if dollar Swissy will be the new dollar yen in the sense that as U.S. rates begin to expand, this is going to be very positive dollar Swissy. So this 91, obviously a very, very big resist. 91.50 is the critical thing. If we can close above 91.50, that's very, very bullish. And I think you could have a move towards 93, 93.50 in dollar Swissy for the time being. Overall, on a longer term basis, it's a very bullish thing. You have a W formation with a potential break here above 91.50 that could take us to a much higher move. Euro yen is kind of dead money right now. We're all looking, we got faked out of it on Friday. We got clipped into it on the break of the yearly lows, and then of course it just found the bottom here. I think it's a tough trade because of the low volatility environment, and certainly on a chart basis, it looks more a buy than it is a sell. So unless I had to close below the lows here, which is what basically I would need it to close below 136 before I'd be happy. Hang on just 1 second, guys. What's going on here? Oh, okay. Before I'd be happy shorting it again. And then somebody wanted to look at the euro com dollar complex. Honestly, there's not. I've been looking at Euro CAD, Euro Aussie, nothing going on. So here's Euro CAD. 2 weak currencies. It's been a sort of 45, 47 trade for a long time. Yes, there's a lot of support here at 45 on the euro. But I don't like these trades because I don't see any clear direction on a trade. Maybe some theme would develop, but for now I just don't see a theme. So it's hard for me to really get excited about the trade. Same thing with Euro Aussie. Clearly Euro's kind of stabilized and Aussie's it's gotten a little bit weaker. So this whole weak Aussie trade could take us to 45, 46 possibly. And yes, on a pippage basis, this is probably, if Aussie weakens, the Euro Aussie trade is going to be a better trade than the Aussie Kiwi trade in terms of pippage. But I think in terms of volatility, it's going to be a smoother trade to trade Aussie Kiwi to the downside than it would be Euro Aussie to the upside. But we'll see. Then this clearly what you see is that the euro has bottomed out against the commodity currencies for the time being, and you do have potential for a little bit more upside. But it's consolidated in my opinion. It's just consolidated. I don't look at the dollar complex or dollar ZAR. I only look at the majors. So I can't help you there, guys. Let's take a look at Aussie CAD for a second. So this is another one of those. Again, I don't like Caddy. I don't like Looney, but I don't like Aussie either. So here it's the battle of the two weakest. Parity, not parity, but 101 is very obviously the next level of decline here. You do have lower highs in Aussie CAD, which really suggests potentially more downside action. So I do think there's a potential here, for us to try to test parity again to the Aussie CAD. I like Aussie CAD to the short side with a stop above these highs over here, which is like let's say 102.50, right? If I'm above 102.50, I'm clearly wrong. But I kind of like this down to parity as an even money trade. So that's kind of, that's pretty much where the charts line up, I think, this week. It's as I said, it's a relatively flat, quiet time. Aussie weakness, I think, could be an interesting theme going into the next couple of weeks. Euro consolidating, pound consolidating, not much really going on. Not that many clear trades to take. So you kind of, you gotta get them, take them where you got them. But the thing that I kind of want to talk about today is something that I think is very obvious, but not very common for most people to practice. And this has to do, in my opinion, of trying to understand what kind of trades we have in the currency market. And, you know, most people who trade basically think in binary terms, that they think we have winners and we have losers, right? But if you are a sophisticated trader, that is not the only option when you're trading. As a matter of fact, if those are your only two options, you probably are not doing the best that you possibly can as a trader. Because there's a third category that most people ignore, that I call, let's say, non-losers, that I think is a very, very important category that all of us need to pay very, very strong attention to. And this is especially true on short-term basis, on intraday basis, which is where I primarily trade, where you have a lot of market movement one way or the other. And the critical thing basically is this. When a trade is great, it's just going to go straight up to your target. Like, let's just imagine you trade. I'll give you real life examples of the kind of trades we do. So typically I have a system that trades, 10-point target, 15-point stop, right? Right? And whenever the trade is really good, it almost just verticalizes. It almost goes straight up into, the 10 points. I don't have to worry about it. But those trades are like pretty much a third to hopefully a half of my trades. The other trades fall into two categories. Complete losers. In other words, you bought it and it literally never goes to profit, and it just almost basically just meanders there and then stops you out. I'm sure you guys have all had that experience where you like, I can't believe I was never even positive for one pip on this trade, right? So you have just pure losers. But then you have a whole category of trades where you were either significantly or partially profitable on the position during a large part of the position, but you never quite got to profit. You never quite got to your target, right? And when you don't get to the target, right? You never quite got to the target, and you stayed in that trade. That float very often actually turned into a loser. So the critical thing that I kind of wanted to share with you, and this is something that I very much do with my own trading, is that we always try to never. Oops, hang on. Let me emphasize that. Never let a winner turn into a loser. And the way we do that, or the way I do that, is I do it through automated EA trading. All of my systems are automated. I no longer, I will occasionally do like proprietary trading, which is just sort of longer term trades. But for anything that I'm trading intraday, it's all automated. And what I have done with my EAs is I've taught them to act very much like the floor traders in Chicago that I used to know, and like all the good prop traders that I used to know who would trade stocks. And every professional prop trader will do the following. What they will do is they'll get into a trade, and if the trade turns positive, right, they will move their stop very quickly to break even, to eliminate risk, right? Now I know everybody's going to scream at me and say, if you move your stop to break even, you're just going to get stopped out. You're not going to be able to participate in the full upside of the move because the market moves both ways. It's very hard to stay in the market. And my answer to that is yes. And my second answer to that is, so what? Because yes, you're going to give up some winners. But if you're trading on an intraday basis, what's much, much more important is to eliminate a lot of losers. And why is it important? Why is it much more important to focus on creating non-losers than it is to create winners? And the reason is actually very simple, and I think this is where everybody who teaches you how to trade leads you astray. You have to understand that when you're trading FX, you start out in a losing position, right? And scaling out profit. Somebody's asking me about scaling out profit within 10 pip profit. That's absolutely possible. But I'm really focusing. I just want to focus on one very, very tight example, DZ, and then we, in webinars that follow, we can talk about more sophisticated strategies. But the key thing I wanted to explain to you is that in FX, you're starting out a loser because the spread is already against you, right? And if you're trading intraday for something like plus 10 to minus 15, right? By definition, if you're at a 50-50 proposition, you're losing, five pips every time you trade, right? You actually have to win 60% of the time just to break even. And the reason why you have to have a plus 10 to minus 15 is because of spread, because it's not really plus 10 minus 15. You actually have to make 12 on the positive, and you only can afford to lose 13 on the negative, right? It's actually even. You're basically making even money trades, but they have to be much more accurate than even money to overcome the spread. And that's just the fact of life. That's just simply how all markets operate. So, if you're not prepared, if you don't have a setup that you feel confident that you're going to win 7 out of 10 times on effectively like an even money trade, then you don't really have a setup that deserves to be traded intraday. But having said this, what's very, very important, right, is that if you already know that you're essentially starting from a losing position, is to really be very defensive in your trading. The whole idea is to think like an insurance company. Insurance companies basically are in a very similar position to you, in a sense that what they do is they collect a lot of small profits, right? They collect a lot of small profits, and occasionally they hit very big losses. So if I'm collecting $1,000 premium from 1,000 people, and then one of those people dies and I have to pay out $1 million, that's okay. But if 100 of those people die and I have to pay out $100 million against just $1 million or $2 million in premiums, then I'm really screwed. So what do insurance companies do to make sure they don't pay 100 people out of 1,000 $1 million in life insurance? They put all sorts of conditions on it. They say, well, you've got to pay your premium, and if you miss your premium, then everything is invalidated. You can't be drinking and driving, because then it's not a condition that we cover because it's your own fault. You can't, if you lied to us and said that you were not a smoker, but you actually have a cigarette in your mouth, or we find some traces of alcohol and you claim that you didn't drink, then our policy is invalid. Basically, they try to weasel out of as many policies as possible, because what they're trying to do is, of course, eliminate risk, right? Same kind of a thing. So what we're trying to do is always eliminate risk. So in a situation like this, where I have a plus 10 to minus 15, there are two strategies, tactical strategies that I use, and it all depends on what strategy that I'm trading. But if I'm trading one of my strategies, what I basically do is if the trade goes plus 7 in the money, right, I move my stop to plus 2, or the EA moves my stop to plus 2. And what that does basically is it assures, and the reason why I do this is because, remember, if the trade has moved 7 points in my direction, right, and then has gone all the way back down to effectively break even, you now have to ask yourself, do I feel 70% confident that after it went all the way forward and then failed to hit my target and now has come back all the way to break even, from this point onward, do I have confidence that I'm going to have a 70% winning ratio at this condition? And of course, the answer is hell no, because you're not going to have a 70% condition once it's gone back on you, right? You'll have a 70% condition if it's gone plus 7 in the money and stays there. And that's fine, because you're not cutting your trade short. You're letting it go to all fully plus 10. But if it's come back down to plus 2, your odds are probably 50-50. And in fact, I would say your odds are close to 40-60 against you, because if it didn't make the cut, it almost usually always going to make the stop. So for you to kind of hang out and be stubborn and maintain that trade is effectively to ask the market to take your money away from you. So one of the things that we do is we use a plus 7, plus 2, but but for other strategies, I actually use as tight as a trade as plus 5, plus 1. That means if I am plus 5 in the money, I will actually move my stop to plus 1. And does that mean I get a lot of scratches? Yes, I do. But basically what happens is, and this is an interesting thing that I think a few people appreciate, is instead of, let's say, in a normal condition, I will have, let's say, 3 losers, 7 winners, right? 70% accuracy. If I'm very, very aggressive with managing my stop, I may actually be able to get it down to only 1.5 losers. So 85% of my trades are either winners or non-winners, and only 15% of my trades are losers. And the less losers I have, the less negative pippage I carry overall, the higher the probability that my return is going to be positive. Even if I have like lots and lots of scratches plus ones, right? It's the negative pippage that really damages your return, because I will certainly have at least 4 or 5 plus 10s on that position, and that'll be enough to to get me into positive territory. So somebody's asking me, how do I overcome news spikes with the risk reward of 10 to 15? Well, the strategy that I trade trades after the news, so it overcomes the news spikes by not participating in them, basically, right? So Nathan is saying, you have to be brave to deal with volatility when it comes back. You're right. So right now, basically, look, the way you look at it is volatility is effectively like sort of 75 points, right? Maybe 80 points in the euro, right? I don't think it's even more. That's sort of the average true range, right? If the euro goes to like 120, like if we have 4 or 5 days, or let's say we have a month where the euro volatility goes from 75 pips a day to like 105 pips a day, then I'm going to expand my my stop and target. Maybe I'll go plus 15, plus 20, right? Maybe, but even though I've got to tell you that I think I've backtested a lot of this stuff on the higher volatility environments when we went in 2011, and it all depends on the setup. If your setup is basically designed to come in at the peak buying power time or peak selling time, you don't really have that much retrace. The point being is that the good trades are just going to be good trades irrespective of where the volatility is at, because it's all about timing the direction. I mean, trading is all timing, right? So if you have a setup that does a good job timing, volatility really is not going to damage it as much as that. But if it does, you can always expand it in a proper proportion to what the volatility is on the overall daytime. But generally, my point is that yes, I spend a lot of my time creating trades that I call, kissing my sister, trades that are very, very neutral, where it's plus 1, plus 5. But by doing that, I eliminate a lot of negative trades. And I'm always much more focused on eliminating negative trades than I am on making positive trades, because positive trades pretty much take care of themselves. You don't have to do anything to make positive trades. Where the real work comes in trading is trying to see how you can minimize the negative trades as much as possible. Boyke is asking me why not plus 20 minus 30. The reason why, Boyke, is because you don't get plus 20 anymore. This is a low volatility environment. Like look at today. When did you get 20 points today? If you bought the absolute bottom and sold the absolute top, that's just impossible. So you don't get those moves today. Nathan says that most trades do go in the money at least slightly, even if they're eventually losers. Yes, they are. And so, it's really a delicate balance between how much in the money you want to give them. Oh, and the final thing I was going to say is this is my final point before I go, is that obviously when the tighter your risk control, the better spreads you need, right? You can't trade plus 5, plus 1 on a platform where the euro dollar is 3 wide. You can only trade it where it's 1.5 wide. So it's really, really important, especially in an intraday trading environment, to trade on as tight a spread as possible, because that's the other component of where you get your risk control, both in terms of making profit, like making target, because you're going to make your targets much faster and much more accurately, and you're going to be able to control your plus 1, plus 5 risk, or plus 2, plus 7 risk much better on a tighter control strategy. I actually have these strategies trading contemporaneously on really wide spreads and really narrow spreads, and there's a massive difference in performance. So that's my final takeaway for you guys to consider. So we got about 5 minutes. You guys can ask me any questions you like about this, and I'll be happy to answer. How many lots do I trade for this? It all depends. I mean, basically, my rule of thumb, it's not a matter of lots. My rule of thumb is I never want to lose more than 1% per day, right? 1% per day. So if the average amount of trades I'm going to do is let's just for argument's sake, let's say I trade 3 trades per day, and my stop on each trade is 15 points, right? So that's 45 pips. And I never want to lose more than 100 pips. That means I allow myself 2 times leverage. So for a $50,000 account, I would trade 100,000 units. For a $10,000 account, I would trade 20,000 units per trade, because I know I'm going to be doing more than one trade, and because I know the control on each one of those trades, right? And that's very conservative. I think you probably could trade much bigger and wider, but I like to, I have a rule of where I don't want to lose more than 1% a day. So yeah, my account tends to be very low volatility. I'm not going to be a guy who's going to take 10,000 and run it to 20,000 in a month, never. But I'm also not going to take 10,000 and ever run it down to 5,000 in a month. It's going to be very, very low risk. And frankly, I'm a little too conservative, and I'm probably going to be taking up my leverage a little bit. But that's the problem you want to start out. You want to start out with the problem of losing too little money instead of losing too much money. So anyways, if you guys want to find out more about the kind of stuff that we do, those of you who are interested in taking a look at the news trades and everything else that we do, feel free to come to our website, www.bkforex.com. And I sent it to everybody. Let me just send it out to everybody. bkforex.com. And I'll be happy to, I'll be happy to send you information. I'll also, I'll send everybody who's registered a link to all the free resources that we have on BK Forex, so you'll be able to download those as well. So Nathan is saying, I like to let some of those run longer and make 5% over your 1%. So I'm sorry, does it mean you're saying you're willing to risk 5%? So you won't take bigger risk on your positions? I mean, that's fine. I'm trying to understand what you're saying. Okay, you'll leave your risk the same. Okay, that's fine. I mean, my whole point here is I just kind of wanted to give you guys some food for thought to make you understand what I think is a more nuanced view of trading, and how, without even changing any of your strategies, how you might be able to actually change your performance by recognizing a lot of these nuances that go into trading. So you guys have all enjoyed it. I got to run because unfortunately I have another appointment. Those of you who are in Europe, I'm going to be on CNBC tomorrow, so you guys can watch me on Worldwide Exchange. I'll send everybody all the free resources that we have here at BK, and everybody come back, and I'll see you guys. I'll see you guys next month. Okay, everybody have a great time.